the marketing material, it's been stated that clearly that I'll be making use of GCB and Car Bank, and I think Standard Chartered Bank as well. Those are the companies that, or the banks that we will be valuing. But there are some other things that we may do beyond just those few banks. Now, what we're going to do today, guys, well, we'll get into some capital market stuff, but we are going to start it today and we'll end it on Monday, as I earlier indicated. And so we get into this model called capital market expectation and discount rates. Of course, they are related today. Almost essentially, we are saying the same thing. We need to make the capital market expectation so we can calculate, or we can get calculate discount rates. The reason is that the discount rate must reflect expectation of what investors want on an asset. And so what we do with capital market expectations about how will the general market perform, not necessarily how a single asset is going to perform, but how the entire market will perform. So oftentimes we deal with this using the indices. So like in the United States, we have the S&P 500. How will the entire S&P 500 perform? So how would the Dow Jones perform? But usually Russell 2000, Russell 1000, but a lot of people just follow the S&P. How will the S&P perform? Okay, so we're forming expectation about equity. That's what I mean. And here we may be forming expectation around maybe how equity, if we see equity will perform, in this case, we mean what will be the expected return on the index. And in a particular sense that we'll be looking at, we are dealing with what will be the expected risk premium on equity. Good. But see, just to give some context to what we will be doing, you see, we want to do valuation. If we want to do valuation, there are, let's say, two or three things that affect the value of anything, of any business, if we want to do valuation. Because valuation has to do with putting value on something whose cash flows are futuristic. It suggests that the cash flows are certain, and therefore there must be a measure of risk, right? It's quite risky, and once things are certain, and then they tend to be risky. So we can tell that the cash flows of the bank or the performance of the bank will be like this or will be like that. We're actually betting on something that will happen in the future. So that's kind of measure of risks that must be there. But I see the measure of risk, there are several ways of measuring risk, Statistically, we can measure risk, use standard deviation, and all kinds of methods, right? But the method you adopt for risk measure must reflect the cash flows associated with what you measure. So if you are calculating the value of a bank or the value of a company, then we must ensure that the measure of risk is measuring the risks associated with the cash flows, because we are basing the valuation on the cash flows. Now, whichever method we use, whether we use a cash flow based approach to valuation or we use a relative method like the price to book, price to earnings, there is always an assumption around risk made. So even if it's price to book, within the price to book is an assumption about risk. It's an expectation of, there is an expectation of risk built into it. And the same argument we've been making when you learn finance for the first time, we talk about the time value of money. We say that the value of a dollar today is worth more than the value of the dollar in the future. And there are several explanations we provided to that. One explanation is that we say that inflation could wipe away the value of money. That's one. And there are other ones that we also provided, or we also provide oftentimes. That one has to do with credit risk, right? And the risks that I may not get even a $1 in the future, so getting it now is better, right? So a bird in hand is worth more than 1,000 birds on the tree, right? If you are promised $1 in the future and you are given $1 today, what you have today is worth more than what you have in the future, because in future there may possibly be a default. So we risks associated with it, even if there is no inflation, there is still some element of credit risk. Now, suppose there is no credit risk, no default stuff, and there's also no inflation. Can we still say that it is worth it taking a dollar today compared to taking a dollar in the future? Yes, we can still say. And that works in a very interesting way. And now, think about something like this. If you are in a university and because you're not working, you are not earning salary, if someone comes to you and tells you that, well, I want to give you $100 today, why would you prefer to take the $100 today rather than taking $100 in maybe in 4 years' time? You know, in 4 years' time, you start work. Okay, so you start working. Forget about inflation. Forget about the fact that the person may not honor his or her promise. Forget about all of that. All we know is that I know that in 5 years' time, I'll start work. And when I start work, I will earn enough. So $100 will mean nothing to me. Okay, so the satisfaction that I'll derive from consuming the $100 today will be greater than the satisfaction that I'll derive if I defer the consumption into the future to consume it in the future. So because of that, you prefer to take the $100 today. It is worth it taking the $100 today because you are in school, you don't have money. Therefore, $100 is so much money for you. When you start work, it's not much of a money for you. So regardless of inflation and credit risk, there is still a time value of money element. In fact, so the same thing applies to economies. So if we expect that the economy is going to be good, there will be high productivity and all that, businesses will do well, and all that, what happens? People will prefer consuming their money today. Okay, so people will prefer not to save much because the future is going to be glorious. What are you saving for when you're going to make so much money in the future? Why not consume that money now? So you have expectation that there's going to be a strong economy. In that case, the banks that need money, the government that needs money to finance projects today, if you are to give the money to the government, then you are going to defer current consumption. So you are deferring current consumption so you can give the money to the government. Now, but you realize that because the economy is expected to be strong in the future, current consumption is worth more than future consumption. In that case, you would tell the government or whosoever is coming to borrow the money from you that, look, if you want this money from me, if you want me to buy your asset, then you must give me something to compensate me for any lost satisfaction or any lost utility associated with deferring my consumption today to the future. So, well, because of that, government will have to compensate you a higher interest rate, right? And the opposite is also true. If we expect the economy to, or a downturn in the economy, then people will actually prioritize savings. And as people prioritize savings, they buy stocks and all that, they invest, and because the future is uncertain, they are saving down. And so there's high supply of money available to those in deficit of fund, like the government and the banks. In that case, interest rate drops. Then that's where you tend to see an inverted yield curve in a recessionary economy, and then tend to see an upward sloping yield curve in an expansionary economy. Now, that is just an argument I'm making around time value of money, how relevant time value of money is. So even if we are valuing a bank or valuing companies or anything, we tend to predict or project future cash flows. We project the future cash flows. And then because the cash flows are in different time periods, we need to index them to a common time period. In other words, we all agree that $1 today is worth more than $1 in the future. And because of that, we cannot sum the two together. You can take $1 in 2025 and then add it to $1 in 2026. No, in finance, you can't do that. Maybe in accounting, you can do, but in finance, you can't do that because they're in different time time period. So, or they are in different years, or they appear in different years. So the value differs. So what do? We need to express all of them with a common denominator. In other words, express them in today's term. And the process of doing that is called discounting. So when we do that, we say you are discounting. And there is something we need to use to discount them. And what we are going to use to discount them will reflect the rates or the extent of loss in value because the item or because the amount in question is in the future. For example, if let's say the value of $1 today we know is $1, but the value of $1, let's say in a year's time, let's say is 90 cents. If it is 90 cents in a year's time, then we can calculate the differential and express and say that, well, the differential in percentage terms reflects the loss in value. This loss in value is arising as a result of time value of money, right? A loss in value. So the discount rate then, which the discount rate actually then reflects the loss in value. The determination of that discount rate varies depending on what you're doing. If we deal with, let's say, fixed income instrument, how we determine that discount rate differs from if we deal with equities. The reason is that the discount rate must reflect the degree of uncertainty associated with the instrument cash flow. So if we have equity and we have fixed income instrument like maybe a bond, now if we have equity, then let's say I have a equity cash flow coming in terms of, let's say, a dividend that I expect in a year's time. And then I also expect maybe a coupon payment in a year's time that I want to estimate what is the value of each of these individual cash flows today. I won't say that each of them can be discounted maybe at a same rate. No, the discount rates that I'll use must reflect the risks associated or the risks inherent in the cash flow. Equities are riskier than bonds. Now think about it this way. For the bonds, you know how much is coming. For the equities, you may not even know how much dividend is coming. You are estimating it, right? So there is a higher uncertainty associated with that. We're going to talk about this more and more on Monday and in future lessons. So just to set the center state, we need to determine that discount rate that reflects the risks. But you see, when we determine discount rates that reflect the risks associated with the cash flows or whatsoever, we need to first start the argument with, look, suppose there's no risk. Are you still saying there will not be any return? Like the argument I made earlier, that even if there is no inflation risk and if there is no credit risk, there may still be a compensation for money. Time value of money still plays a role because of the fact that I have to defer my future consumption to satisfy the present needs. And that concept is what we call consumer preference theory, right? The consumer preference, consumption preference. I'm sorry, I say consumer consumption preference. Now, think about it this way. Investors require return on any investment they make. Now, to build what the return should be, there are a lot of things we need to consider. Number one, we need to think about how long are we even holding the instrument? And so the longer the risks, but that does not necessarily work in every single case. Longer term instruments sometimes could even attract a lower risk. In fact, in a lot of debt instruments, they tend to even attract a lower risk compared. Let's say a 20-year instrument versus a 10-year instrument. The fact that we have a 10-year or a 20-year, 50-year doesn't mean that the 50-year tends to worsen, right? Think about a situation whereby a government issued an instrument. We know that the government will not be wiped away. Parties may come and go, but at the end of the day, the government will still stand. If the government in the short term run into trouble, the government may be bailed out by maybe the IMF, right? The government will come back again. Later will come back again. And several governments have gone through serious troubles and they go back to their feet. So if you are dealing with a short-term instrument, it may even carry a higher risk, because in the short term, the government may run into trouble, the country may run into trouble, the economic situation in the country may be traumatic, and inflation, currency depreciation, and all that could actually damage the economic fundamentals. But in the longer term, the country may get stabilized, right? Now, so when we make this argument, it's not that once it's a short-term instrument, then the discount rate must be low. If it's a long instrument, the discount rate must be high. Now, think about a situation where we have in the short-term interest rate is quite high, but longer-term interest rates are low. So there are a lot of aspects to this. It's not a clear cut, right? When we discuss matters like this. Now, so when we build returns on any instrument, and we first start the argument from, suppose there is no risk associated with the instrument, what could be the return? And once we determine that, then we can now ask ourselves, what is the compensation for the risk I'm carrying? Then I get a compensation for the risk I'm carrying, and I add it to the return with no risk, and then that will give me the yield or the expected return on the instrument. Okay, so we started with, suppose there is no risk at all, what will be the return with no risk? And then we ask ourselves, what's the price of risk, or the risk I'm taking on now? Is there compensation for that risk? Okay, then we determine the compensation for the risk, and then we add it to the return with no risk, and that gives us the return on the instrument. Now, as I mentioned, Monday, you estimate the price of risk, or we calculate the return that investors are going to be compensated for bearing risk. You'll deal with that on Monday. But today, what we're going to be doing is that we are going to be estimating the return on an instrument that is risk-free, or suppose there is no risk, what would be that minimum return? You'll be wondering why discussing all this, because risk-free rate is easy. Why wouldn't you just go out there? The government is already risk-free. As a lot of people think, the government is already risk-free. So just go out there and just pick the yield on a government instrument that is risk-free. No. There are questions we need to answer to determine whether truly government is risk-free. Putting that aside, there are several models that are equity analysis that you can use to forecast returns. And in each of these models, you tend to see the risk-free rates there. The risk-free rate, as I mentioned earlier, gives us the return if there is no risk. And then we look at the risk, and then we determine the compensation for the risk. In equity, in general, risk measured using beta, but not in every case. What you see a lot of times in your textbooks is that risk is measured using beta, but not really so. The best measure of risk, at least we use in equity analysis, or the commonest, is standard deviation. There is a reason why beta is used and not standard deviation. When we meet on Monday, I'll explain why we don't use the standard deviation, but rather we use the beta in some of the models. And if I say some of the models, I mean models like the capital asset pricing model, right? The CAPM, that is very common. And I'll talk to you about the CAPM. I'll also tell you where the CAPM got it wrong, and what can we do if the CAPM is wrong, right? And whether CAPM is relevant in our markets here. And if it's not relevant, are there extensions we can do to the CAPM to make it suitable for use in our market? And even in developed markets, whether CAPM is even accurate at all, whether CAPM captures the risk at all, right? But today, the discussion will be on determining that return on an instrument with no risk. Or suppose I'm taking on no risk, what will be that minimum return I need to get? It's going to be an interesting thing to cover. Now, let's start it this way. Let me check if there's any question in the chat. No question. Okay. Now, let's start it this way. And we need to start by answering the question, what is risk-free rate? or what do we mean by risk-free rate? Now, whenever we talk about risk-free rate, the question we should actually be answering over here is, what can we actually make on a guaranteed investment? If we see a guaranteed investment, it's an investment that you made and you are promised that you get so and so amount. Give us $100, we're going to give you $200 back. Guys, I'm not talking about the fraudsters, right? Now, I'm talking about credible institutions. So that is what we call a guaranteed investment. And not just that, give us $100, we'll give you $200 back. But give us $100, we'll give you $200 back. And the one who is making the claim is actually a credible institution. And that institution have the capacity to repay. And not just that they have the capacity to be paid, but that institution is regarded widely by investors to have the capacity to repay with no sense of defaulting on it, right? So that instrument is considered, or investing that instrument is considered a guaranteed investment. So the yield on that guaranteed investment is the risk-free rate, or the return, or the interest rate on that guaranteed investment is the risk-free rate to start with. Now, the whole idea is when we do finance or whatsoever we do in any discipline, we don't start it by telling you this is what you should do. We tell you the principle that governs the world in finance. The principle is that for something to be risk-free, so and so must be there. If they are not there, it's not risk-free. So use that criteria or that principle to evaluate anything you want to use to evaluate. Now, I just said something that the return on a guaranteed investment is what we considered the risk-free rate. And I hope that is really clear. Now, because we are saying that the risk-free rate is the return on a guaranteed investment, then it means that the one who is issuing the instrument must be a credible institution. The credibility here means that the institution promises and the institution delivers. Now, historically, the institution could promise and deliver, but that doesn't mean that the institution will be credible or is credible going forward. So when we are assessing credibility, it's not just about historical performance, but also about the future. And here, it's a matter of the willingness of the institution and also the ability of the institution to repay whatsoever money that's borrowed. Very important. Now, so what a risk-free rate is, I'm saying here that the entity issuing that security must have no default risk. The entity has no default risk. Not having default risk doesn't mean that it might not have defaulted in the past. You see, the issue of default risks here is a matter of probability. What's the probability that so and so company would default on its debt? What is the probability that so and so country would default on its instrument? And we experienced an event in Ghana, right? In 2022, 2023, where we had the domestic debt exchange program. The government defaulted. Now, a default event can occur in several ways. The restructuring of the existing instrument or of the debt constitutes default. The government failed to meet its obligations and they have to restructure the instrument. So that's a default. But suppose there's no even default. Government of Ghana had never defaulted. Suppose something like that is. Can we still say that it's a risk-free instrument issuer? So I'm saying that the entity itself must have no default risk. And when we evaluate the past, well, what have been the dealings in the past, and then the future is more of the future than the past. Okay, so we're looking at in the future, are you likely to pay or you are likely to default? So that's how we evaluate that. Right. Now, since we are saying that it has no default risk, it means that whatsoever the entity promises is how the entity is going to deliver on. So if the entity tells us that it's going to pay us 10%, we expect to get 10% from the entity. You get a point. So we expect to get a 10% from the entity without fail, and the entity will deliver without fail. In that case, we say there is no default risk. If we have that expectation. Now, if there is no default risk, then two things, or then a condition, or maybe a conclusion can be formed here. The conclusion is that if there's no default risk, then we can say the actual return on the instrument will be equal to the expected return. In that case, if we buy the instrument and the instrument is promised 15%, then that is the expected return, right? At the end of the life of the instrument, we expect that our realized return is also 15%. In that case, we say there is no default risk. That's very important. Now, these things will get you thinking. You'll be wondering that, think about government of Ghana. Government of Ghana have been issuing bills, okay, treasury bills. And foreigners buy the bills, the locals also buy the bills. Now, government promises 91 days that I'm going to pay you 22%. In 91 days time, you get your 22% divided by 4, okay, because it's an annualized rate, right? Just giving this simplistic analysis, right? So you get your return in 91 day time. So will you conclude just by saying that government of Ghana instruments are default risk free just because they've added that? Maybe, maybe not. We'll get into it. But there are some formal requirements that must be observed when we define what constitutes a default risk-free instrument. The first one is that there is no default risk, meaning the government will not default. The government will not default. It is expected the government will not default. In fact, there's an absence of default. The second is that there is no reinvestment risk. The second one here, I will have to explain again. I issued a paper on these, I think somewhere early part of 2024. Yeah, I think early part of 2024 or later part of 2023 was published by KPMG, and on this issue of risk-free rates. And you see, when we talk about reinvestment risk, the reinvestment risk works this way. Suppose you've bought a 91-day bill. You are holding it for 91 days. In between that period, interest rate is going to be stable. Within a 91-day period, you don't expect interest rate to change significantly. Even if interest rate is changing in the economy, because there are no intermediate cash flows associated with the 91-day bill, you will not suffer any risks associated with reinvesting those cash flows. Because you are buying, these are instruments to buy, and there's no coupons associated with them. That's with their bills. Those bills are discount instruments. So there are no coupons associated with the bills. So when you buy the 91-day bill, nobody gets to pay you coupon within that 91-day period. So you don't have any cash flows coming in that you have to reinvest again. So when they promise you a discount rate, or which the equivalence of an interest rate, the rate on the 91-day bill, when you hold it until the end of the 91-day period, that is what you are going to get. So there is no reinvestment rate associated with the 91-day bill. Maybe we can say the same thing for 182-day bill. Maybe even for 273-day bills, or for even 365-day bill. All those bills bear no coupon. Therefore, there are no intermediate cash flows that have to be reinvested. So the promised return or the promised yield is what you end up getting. In that case, your actual return is likely to be well to track the expected return. So there is no reinvestment risk. Now, where does the reinvestment rate comes in? Suppose we have a 5-year note. If we have a 5-year note, a coupon paying note, and then the coupon comes in semi-annually. So when a coupon comes in, theoretically, what we do in finance is that when a coupon comes in, the coupons are reinvested in another note or another bond with similar interest rate or with even a higher interest rate. It depends on how the portfolio manager is making a decision as to whether he's going to chase a higher interest rate or a longer duration or whatever. It all depends on the risk dynamics, right? And we're not talking about fixed income risks and returns here today. But when you buy the bond and the bond pays you coupon, the coupons have to be reinvested. Now, as at the time you were buying the bond, you know the interest rate. And that's the difficulty with bond pricing. You know the interest rate at the time you're buying the bond. Now, in between the time you bought the bond and the time the bond matures, I'll be using the word note and bond interchangeably, right? Now, so you bought a bond today and you bought it at a price. You know the coupon associated with the bond because easy. All you need to do is to multiply the coupon rate by the principal or the face value of the bond, right? Now, so you know the coupon really well. You know the price of the bond. What you also know is that you know the tenor of the bond, right? For sure, you know the tenor. You also know the face value of the bond, how much will be given to you at maturity, right? So let's see the things you know. You know the price today. You know the coupon rate, so you can calculate the coupon amount, and you also know, and I over here I assume that the coupon rate is a fixed rate, right? You also know the tenor, and you know the face value of the bond. So these are the things you know. But why are bonds difficult to price? Why are bonds quite uncertain? Well, this is the reason. In pricing a bond, you want to discount the cash flows, right, associated with the bond. Now, already you know the coupons. You know the coupons, so that is not a difficult thing for you. You already know the coupon. What you don't know is the interest rate. You see, if I am just buying a bond today and I'm going to hold that bond until maturity, I don't really want to care about what happens to interest rate in between the time I bought a bond and when the bond matures. Because I know they promise me, whichever way the economy goes, I will end up getting that amount. But I may still bother though because of the coupons, the intermediate coupons that will come. But I just wanted to look at something here. Now, when the coupons come in, they have to be reinvested. The rate at which those intermediate coupons will be reinvested is uncertain because as time passes, interest rate changes. Interest rate changes, new instruments are issued at different rates, and you have to reinvest your coupons into new instruments. So you are going to be reinvesting into, maybe if interest rate is dropping, then you are going to be investing at a lower yield, and then your investment get compounded at a lower yield. Or if interest rate is rising, you are going to invest at a higher yield, and your investment have to be compounded at that yield as well, right? This leads to a whole lot of arguments. If you take the CFA program, of course, you see, I think it's level 1 when you do with fixed income instrument, that brings about the story of on duration and convexity and on all those kind of stuff, right? Macaulay duration and stuff. But what I want to focus now on is this: because of the uncertainty in the interest rates at which you'll be investing future or maybe intermediate cash flows, your realized return may be different from the expected return. The expected return, I mean here, was the initial yield on the bond. So the realized return will be different from that. Or in other words, the actual return you make on a bond at the end of the bond maturity period will be different, even if you hold a bond to maturity, because the coupons get to reinvested at different rates. So the yield to maturity story is making a simple assumption that the interest rate on the market will not change. In other words, there will be a flat yield curve. So coupons will be reinvested at the same yield to maturity, which you may not get, right? Good. Now, because of changes in interest rates and that coupons come in regularly, if then you are exposed to the future interest rate as far as reinvestment of those coupons are concerned. And then we conclude that there is a reinvestment risk associated with that. So a 10-year instrument has a reinvestment risk associated with that 10-year coupon paying instrument. A 5-year coupon paying instrument has a reinvestment risk associated with that. Like once the coupon comes in, it has a reinvestment risk associated with that. But think about a 91-day bill, no reinvestment risk associated with that. I hope that is very clear. I think there's a question in the chat. Let me quickly take that. How then do you calculate risk-free rate for a competitor business which has never issued a security before? Do you use a TV rate for the risk-free or the company A that gives the guaranteed returns risk-free as the risk-free for the company? Oh, Nelson, don't worry. We're going to get into that, how risk-free rates are estimated. So I'm not going to rush the lecture. We have enough time to get into that. So just stick with me, and I will deal with all that for you in a jiffy. We will learn how to calculate all these metrics. So you don't have anything to worry about. I'll show you. So in this case, you can see clearly that not all government securities are risk-free. Not all government securities are risk-free. Yeah, not all government securities are risk-free. Because for you to be considered risk-free, there must be no default risk, right? And there must be no reinvestment risk. So a government may have no default risk, but may issue instrument that has reinvestment risk. You see, the two must be met. To get a true risk-free instrument, the two conditions or requirements must be met to have a true risk-free instrument. All right. Enough on that slide. Let's get to the second one now. So how do we then identify a risk-free security? Which security is risk-free? How do we identify it if a security is risk-free? Now let's think about it. Now, we stated earlier that for an instrument to be regarded risk-free, the issuer of the instrument must have no default risk. Now, on the market, there are agencies that grade or that rate countries and companies to determine whether the level of risk they carry, right? Yeah. Or whether they carry no risk at all as far as default risk is concerned or credit risk. Now, when we want to start the argument, and this is a point, just the same way when we're building the argument to on risk-free rate, with discount rate, we said that to determine the discount rate or the required rate of return on any investment, we want to start with defining or determining what is the return on an investment that carries no risk, right? Or that's the return we can still get even if we carry on no risk. What's the return on that? We started argument with that, right? Now, the same way, when we come to this end and we asking ourselves, well, how do we determine a risk-free instrument? Why won't you start the argument from an issuer that has no default risk? Maybe let's start from there, right? Because then we need to define what we mean by an instrument, an issuer having no default risk. Like, think about the US market, the US government. The US government treasury issues the US bonds. And these bonds are regarded as rated AAA. Okay, it's AAA rated country. So a AAA rated country has no default risk to start with. That's the meaning. Now, so we begin the argument from there. That's why we always have to begin the argument from the US market. In most finance textbooks, a lot of arguments are begun from the US market. The US market is used as a reference point in everything. We use the US market to start argument. Now, once we get into the US market, because US market is AAA rated, so we started argument from the US market, and then we can find a risk-free instrument. But this is the point. When we go to the US market, we've only checked one condition or one requirement. There are two requirements. Number one, there must be no default risks. And number two, there must be no reinvestment risk. When we enter no default risk, so there's no default risk on the US instrument, that is fine. The second one is yet to be checked. So the second one has to do with the instrument in question. Now, so the US government issues wide range of instruments, treasury instruments. So which one is default risk free? So as I said, next is to make the choice between various maturities of US treasuries. So we have the 91-day, we have the 1 year, we have the 5 year, we have 10 years, we have 20 years, we have 30 years. So which is risk free? Okay, so which one are we picking as a risk free rate? Now, when you take it, you realize that the risk free rate should be the one, the shortest maturity, like the 91-day bill. Because the 91-day bill will be meeting both criteria. Number one is issued by an issuer that is AAA rated, has no credit risk. And two, it has a shorter maturity period, and there are no intermediate cash flows that will need to be reinvested. So there's no reinvestment risk. So 91-day bill tend to meet the requirement of a true risk-free instrument, and that is true. Depending on the capital markets work you're doing, you will go for the 91-day or something else. If you are doing maybe equity analysis to get returns on a short-term investment or something, you tend to match maturities and you will be thinking about a 91-day bill. Now, if you're doing something like valuation, my recommendation is that you go for the longest term you could find. If I know my recommendation generally for valuation, because valuation is something long-term oriented, a valuation where you are valuing for the purpose of keeping stock in the portfolio for long, right? Or maybe business valuation, you need to go for the longest term, right? The longest term. And the longest term, suppose we have a century bond. You may be thinking about a century bond, right? A 100-year bond, but not really. The recommendation often is a 10-year bond. You see, we use 10-year bond for several reasons. Because a lot on the 10-year bond is considered very liquid amongst the bonds, very liquid, because even in the futures market, the derivative market, a lot of derivatives are actually traded against the 10-year. For example, the bond futures and all that are around the 10-year US government bond, right? And so they are highly liquid, right? They're highly liquid and the yields are quite good. Number two, the 10-year bond provides a good source of information for gauging economic expectations or expectations about future economic situation in a country. So if we have a country's 10-year bond that is higher, the yield is higher than the short-term bond, a short-term instrument, it tells us a story about an upward sloping yield curve and some story about expected inflation. Tell a story about expected inflation, and that is what's going to help us to price in inflation, or maybe determine inflation, narrow expectation, and maybe for our economic work, or maybe some macroeconomic work, or maybe some investment analysis we want to do. So the 10-year bond is quite important. So we tend to focus on the 10-year bond. Great. So that's my recommendation here. So even though the 10-year bond is not, even though the 10-year bond is not free of reinvestment risk, we still use the 10-year bond for the purposes of business valuation. The 10-year bond is still the best instrument to use here, and not a short-term like the 91-day bill, because there's high volatility around the short end of the curve. If we take the yield curve and we have a 91-day and overnight rates, 91-day, they tend to be quite volatile because of monetary policy decisions tend to affect the short end of the yield curve. The longer end of the yield curve tends to be affected by fiscal policy decisions, and the shorter end tends to be affected by monetary policy decisions, right? So the monetary policy decisions don't really help much, right? The fiscal policy decisions tend to impact the GDP really much, economic productivity, and the long-term economic productivity really will match, and that affects generally the economy, right? and companies that operate in the economy. So 10-year bond is something we're going to go with. So I've actually set the stage for any future work we're going to be doing. I think there's a question here. Does going for a 10-year bond violate the reinvestment risk criteria for it? Yeah, that's true. It violates it. You know, the funny thing is that in finance, we tend to know the problems, but we still go with it. So when you are doing it, you know why. You know all the arguments around why you shouldn't use that methodology, but you still use it anyways, because it answers other questions for you. And so when people use measures, maybe somebody's using 91-day bill or maybe a 2-year or 3-year something, you don't just uprightly say that the person is wrong. You need to understand the objective of the assignment, and that guys in the determination of the appropriate yield to use. Appropriate yield to use. Great, I hope that is good. We can proceed. So what have we been doing so far? We define what a risk-free asset is, and also we determine or we discuss how to identify a risk-free security. The next thing we are going to do is the actual estimation. And I want to take my time here because sometimes it can get confusing. On Monday, the kind of things we're going to cover will be a little more complex than what we do today. Because Monday, we try to estimate equity risk premium. And equity risk premium that we'll be estimating will involve a lot of things because we are doing so for a bank in Ghana. Okay, we want to value a bank in Ghana, value any company in Ghana. And also about we learning can be applied to any other company. That's why this lecture, even though it's for commercial bank, but the capital market expectation aspect and the discount rate aspect is well applicable to non-banking institutions as well, right? Industrial corporates. All right, so we're going to work on how to estimate risk-free rate. Now, so how do we estimate the risk-free rate for local currency? We know how it is done in the United States. Very easy. All you need to do is to reach out for a 10-year US government bond, a recently issued 10-year US government bond, and pick the yield on that bond. You are done. So you see, it's very easy to do it in the United States. Very, very easy. But what if we are not doing it in the United States? And you and I, we are in Ghana, and there are others that have joined from other countries. In emerging economies, how do we handle these things? So we are evaluating the investment in Ghana, and therefore we are interested in a risk-free rate that reflects conditions in Ghana. Now, how do we then do? Let's start arguing it like this. The first thing we need to do is to find a 10-year government of Ghana treasury, meaning those instruments denominated in CD here, that trade here. So 10-year government of Ghana treasury. And let's say you found one. Let's just, we're building a theoretical, we're just building a scenario, right? So let's say you found it to be 25%. The question you need to ask yourself is this your risk-free rate? You know, the argument people make out there, because it's instrument issued by the government, it must be risk-free rate. It must be risk-free. So in several textbooks too, anytime they define risk-free rate, they say, oh, yield on government instruments. No. That's not entirely true. And from the analysis we've been doing so far, you realize that is not entirely true. To say that the yield on the government instruments, just because it's a government, is risk-free. It's not true. So now you have a better argument if you've never known this until today. So when you meet colleagues or you meet people in practice, or maybe you are presenting your work to a client or something, or whichever way, you improve upon your estimation and tell a better story. Now, so the 10-year government of Ghana Treasury is, the question is it risk-free? Now, there are matters to consider. Now, so the first one is that you need to check if the rate is default risk-free. Is that 25% default risk-free? Now, we can use the sovereign rating. sovereign rating, Moody's, Fitch, and S&P provide rating for corporate sovereigns. And this has to do with governments. Okay, so they provide regular ratings, and you can use that to check if your country in question is risk-free. And we know if it is risk-free, it will be AAA rated. And let me say something. When I say risk-free, I mean default risk-free or credit risk-free, not general risk-free, because default risk is not the only risk. That's why in a risk-free, when we say a risk-free rate, there are still risks in it. But here we are talking about default risk-free rates. There are still risks in it. And think about it. Risk-free instruments to have risks set at inflation, right? Inflation expectation, inflation premium is there. So there's still risk. 10 premium is in there. There's still risk, right? Now, so check if the rate is default risk-free. And how you can check, you can use a sovereign rating. Now, if sovereign rating is available for the instrument, you use it. Unless sovereign rating is not available for the instrument. Or in other words, Moody's, S&P, and Fitch are not following that country. In other words, they are not rating that country. Now, based on Ghana's rating, we can determine how much sovereign default spread to charge for investing in government of Ghana bonds. Now, let me go back to the 25%. You see the 25% there? We're asking two questions. Is the instrument risk-free? Number one. And number two, is the instrument free of reinvestment risk? But we've settled that matter. And we said that even though the 10-year bond has reinvestment risk, we still use the 10-year bond. So that's not an argument to make again. So the key argument you're going to be making going forward is that we're going to be asking if the instrument is default risk-free. That is all. And we found a 10-year bond in Ghana that is trading at 25, or that was recently issued at 27%. And then we're asking ourselves, is that instrument risk-free? And we are saying to determine whether it's risk-free, the issuer of the instrument must be risk-free. And which is the government. So the governments across the world are rated by a rating agency, Moody's, Fitch, and S&P. Let's check with them whether government of Ghana is rated. If government of Ghana is rated, which actually is true, then let's check for the rating of government of Ghana. Once we check the rating, we can determine if it's risk-free or not, default risk-free or not. Okay. Now, if government of Ghana is not default risk-free, then we can actually conclude that the 25% there is not risk-free. It has an element of a return that is compensating investors that buy its bond for bearing a credit risk. That's the whole idea here. Now, let's think, guys, let's think about this. Wow, did it, right? Think about government of Ghana. The bonds issued by government of Ghana. These bonds are not purchased by only you and I, you and me in this country. We don't just purchase the bond. The locals are not the ones that purchase they are not the only people that purchase the bond, right? The bonds are purchased by foreign investors as well. And we discussed this yesterday. Foreign investors invest in government of Ghana instrument. They buy the city bonds. Now, when you are in the country, you may say that the most credible institution is the government. Why? Because the government has the capacity to tax everyone. They can tax you also. They can tax you to use the same money to pay you. They will tax you and use the same money to pay you. So government can do anything they want to do, right? So within the borders of the country, the government is credible. We can do that. You can say that, you can make the argument. But you see, when we do investment, we take a global perspective. We don't take a local perspective in making investment decision around risk. We take a global perspective. Think about it. Someone who is in the United States, who is buying a bond in Ghana, won't care about the things you care about. He's thinking about, look, he's not going to say that, oh, government of Ghana, oh, come on, it's a credible institution. No, look, he's going to see government of Ghana as an institution. He's going to evaluate whether that institution is credible or not. Will that institution honor its obligation? So government of Ghana knows that, well, we are not AAA rated. We are not the most credible out there. So foreign investors may not view us the same way they view the US government. So when we want to issue this instrument, let's add additional return, something to the interest rate. Let's increase interest rate a bit so that those outside there who don't consider us close to US or United States government will be enticed to buy our bonds. So in that 25% is an element of credit risk premium. There's a question. I said so determining the risk-free rate, are you going to use the current yield on the 10-year bond or the coupon rate at issuance? Oh, of course, I'll use the yield at issuance. So I'll be looking for the. Now, I'm going to cover this, okay, but let me just give you some information on that. So I will look for a recently issued bond. I'm not going to be looking for a bond issued 1 year ago. No. Because that bond issued 1 year ago, the yield on that bond was reflecting the economic circumstances at that time. Okay, but now things have changed, so it's invalid. But if the bond is actively trading today, if I can get a yield on a bond that is actively trading today, why not? I can consider that. Mamle is asking, is the sovereign rating for the government different from the sovereign rating for the instrument? It could be, but let's look at it this way. If the government issued multiple instruments and then there's a rating on each of these instruments, some of them may be more credible than the other, depending on how the instruments are structured, right? But it's an argument I don't want to get into. But what I want to say is that, well, you can rate an instrument AAA and rate the government C, right? It's the one that's going to pay. So I don't think it is fair to rate an instrument better than the rating of the issuer. If anybody has maybe an argument on that, can bring it up for us to look at further. All right, let me continue. The point I've been making. So that 25% is not entirely risk-free. The government implicitly is considering a premium. And it's considering a premium in the 25% because it knows that it's not AAA rated. So investors are going to see the government as not being AAA rated. Therefore, because it's not AAA rated, investors are going to consider the government to have a default risk. And therefore, they are not going to just accept it like that. So government will then give them some compensation. So that 25% is not risk-free. Even if the instrument is issued today by government of Ghana, 10-year bond, it's still not risk-free. Even if you may be thinking that, oh, because of the DDP program. No, even before the DDP program, I have never tried to use government of Ghana instrument as risk-free. I've never considered them as risk-free. The DDP program tend to tell the story. You know, wasn't the case. It had never been risk-free because the government of Ghana is not AAA rated. I think there's a question. Anthony is asking, from CFA fixed income analysis, I learned we have price risk and reinvestment risk, but why is the price risk not used in rating? In rating, I'm coming up. Why is the price risk not used in rating? I think there's something covering this, so I'm not able to. Just a moment. But rather reinvestment risks. Now, you see, okay, so what I'm doing is that I'm defining a risk-free instrument and I'm using the reinvestment risks. And the whole point is that because there are intermediate cash flows that are going to be reinvested at different interest rates, there are going to be intermediate cash flows that are going to be reinvested at different interest rates. we are likely to have a realized yield that will be different from the expected yield. That's I was talking about as a reinvestment risk. Of course, you mentioned the CFO program. Now, let me tell you more about the issue of price risks and all that. The whole thing is this: when a bond is issued today, between the time the bond is issued and the time the bond matures, interest rate may change. Okay, now, so if I get a price of the bond today at $90, okay, and I know the par value of the bond to be 100. Now, in a month's time, if I have to reprice the bond, I'm not going to reprice the bond at the yield curve that existed at the time I was buying the bond. At the time I was buying the bond, I know the interest rate expectation on the market. So the bond was actually priced along that curve. Now, in a month's time, if I want to reprice this bond, I'm not going to be, the yield curve that was there 1 month ago might have vanished, might have been updated. Okay, things have changed, interest rate might have changed. So I'll be repricing the bond along a revised yield curve. In that case, the price I'll be arriving at actually is going to be different from the initial price, not just because the price must not be different. In fact, even if the yield curve is flat, the price will still change. Okay, price over time will be changing. But here I'm talking about price changing, not necessarily because the yield curve is flat, not necessarily because of the passage of time. The price is changing as a price about because of the changes in interest rate, and that's what we call price risk. Okay, now the reinvestment risk here is associated with the cash flows that are coming in. The two risks must be balanced, and a point where the reinvestment risk, sometimes the reinvestment risk, you can make a gain on the price and lose on the reinvestment risk. Think about a situation whereby interest rate is 10% at the time the bond is issued, and then 1 month's time you reprice the bond, and then you price the bond out at a low interest rate of 8%. In that case, the price of the bond is going to be higher because of the inverse relation between bond price and interest rate. So the price risk is on the positive side. But the coupons, the future coupons now will be reinvested at a lower rate, will be reinvested at 8% instead of 10%. In that case, you are going to lose on reinvestment. And so there is that kind of thing where the price risk or the price impact may dominate or the reinvestment impact may dominate, but there's a point where the price impact and reinvestment impact match. They cancel each other, which we call the Macaulay duration. Of course, as you mentioned, the CFA program. So you see that also there. We are focusing on the reinvestment risk because our concern mass is on the cash flow affecting the yield, not necessarily the price in this case, even though the price also get affected. But then we are looking at which instrument has no cash flow. But just think about it. If the instrument has no cash flows that have to be reinvested, the price risk, the price doesn't really have much risk like that. Think about a 91-day bill. Like, is there price risk? Not really, because the duration of a 91-day bill is extremely small. So even if interest rate changes, the price impact is extremely small, right? I think that I've exhausted that. There's also, I think, the question in the chat. I want more of these questions, so I can address them. So Efion is asking, do you mean that the sovereign risk rating supersedes the facility rating, risk rating? No. If we say the facility risk rating, you are talking about the risk rating of what? The instrument. Look, but if there are multiple facilities and they have different ratings, think about it. How are you going to resolve that? There are multiple facilities and they have different ratings. Which one are you going to select? But what we are interested in, let us not get into the very details of the issuer's instrument. Here, we are talking about, we as investors, we want to calculate what is a risk-free rate in a country. And we know that to talk about risk-free rate, we referred the argument to the government, and then the government must be triple A rated. So a triple rated instrument tends to be risk-free. The reason why we have to consider the sovereign rating is that generally the sovereign rating is common to all the instruments issued, right? And then we know that because of rationality, investors will consider that the issue of the instrument compensate them for the sovereign risk that they are taking on, right? And he said that assuming a Nigerian buys a triple A rated corporate bond from a company in Ghana, on what basis will such debt instrument be valued? Will it be valued on the obligor, the company issuing the bond, or the sovereign, the country of origin? Definitely it will be valued at the level of the obligor, right? But the argument again here is that we are determining a risk-free rate. And when we determine a risk-free rate, we can determine at the level of the obligor, because corporations can be the best measure of risk-free rate. Think about it, the distance between the gap between a corporate body and a government in terms of credit risk is wide. That's the reason why the instruments issued by corporates are called credits, okay? And government instruments are called treasuries, right? Let's see how it's going. Thank you, Julia, well understood. I'm thinking sovereign ratings can be different from instrument. Financial structuring can be introduced to improve the rating of an instrument. Oh, well, that is true. It can be introduced, but think about the bottom line is that a decorated monkey is still a monkey, right? Even if you try to decorate the instrument anyway, everybody knows the government is not credible. Now, you see, I know why you go into. Now, if you get into structured products where we have corporations that issue structured product, and then we have some in the triple A rated, double A rated, and all those things that can be done actually at a corporate level. But I'm wondering how government is going to structure that at their level. But what is the level of risk in the government? What's the level of risk in the country, the macroeconomic, space? What's the level of risk there? And that is what we're talking about, not instrument by instrument. We are saying we are looking for the risks at the level of the economy, and that gets reflected in the government and the government sovereign spread, right? So in a situation whereby there is no risk associated with the government, you tend to have the sovereign spread being zero. At the end of the day, like the US government, like that. So we tend to see the US government as being credible. So you see, when we looking at returns, or we want to forecast returns in any way, we want to start the argument by first looking at the macroeconomic environment to start with, and then before we look at any company within the macroeconomic environment, that is a starting point of the argument we will make. But the thing is that why is it that, and think about it, most countries actually float bonds outside the country. Think about the government of Ghana. They float Euro bonds, right? The Euro bonds that are issued, they won't get to the market and you see the Euro bond, the interest rate on the Euro bond very close to that of the US government. No, there's a differential in them. It tells you that the investors are considering government of Ghana bonds as risky, and that's why they are considered junk bonds, right? They are non-investment grade bonds. Am I even considering non-investment? These are junk bonds, right? They are risky bonds. But the US government bonds are investment grade. So even if you want to structure your bonds, you want to, in terms of credit rate, you want to consider one to be maybe like, you maybe call for rating for your issues, right? And you group them in buckets of maybe credibility in terms of, well, this in mezzanine bucket, this in equity, and this is in a high quality, whatever. People will still see all the buckets as coming from the issuer. And the question they will ask is the issuer credible? Not necessarily whether the issue is credible. Okay. If you only say, okay, thank you for clarifying it further. I get a context of the sovereign being a better approximation of the risk-free rate now. Thank you. Thank you. Great. Now, so let me just I like the engagement, and I want to promote this right further. Let me just wrap up with this, or wrap up on this very slide. So we are saying that even though government of Ghana is a sovereign, and the instrument they even issued are treasuries, they are issued in their own country, they are issued in Ghana City, the government has infinite power to tax people, to tax the population and make money. We still don't consider this as risk-free. Let me say something here again. investors coming in are the major concerns of the government. If it were just people within the country, they may not matter much, they may not care much. Because look, suppose in the whole world, Ghana is the only country, and we are in this country, like government is not competing against any other country. Ghana is not competing against any other country. So there's the only credible institution in the world is Ghana. It's the most credible, you see. But here we are talking about League of Nations, right? Nations are competing against each other. Some are doing well, some are doing better than some. Some are more preferred to some. So at the end of the day, that competition is there. And just like corporations, okay, so there's someone that is much more credible. Everybody that's looking for quality instrument will run to that issuer. They all run to the US government. They all chase quality, right? In crisis, everybody runs to the US government. Even in 2008, when we have the global financial crisis, a lot of money still moved to the US economy. Think about it. And the US economy was still considered a safe haven economy, even though that was where the problems were at that time. So the US instrument is not risk-free. So the government needs to entice investors to come in and they increase interest rate. So in those interest rates, the government is compensating foreign investors for buying its bonds here in Ghana. Good. I'm not sure there's any question in the chat. Okay, I think there's one here. Okay. So if you put something there, if you want to know more about the CFA Society Ghana, please you can do that. And also to say you like the YouTube channel, and also you subscribe, right? You like and subscribe. It's very important. Creating some of these educational videos is quite expensive, but again, we want to promote education in the country, and our role in that is important, right? We, as much as possible, so people get knowledge. Knowledge becomes readily available to people, which is a good thing. Some of us are committed to that. Now we've made the argument. Let's look at arguments from the beginning. We define what we mean by a risk-free rate. We went ahead to identify a risk-free security, and we say that two criteria must be met. The instrument issuer must have no default risk, and the second one is that there must be no reinvestment risk. Those are the things we looked at. Now we went ahead to now look at how to estimate the risk-free rate for local currencies. A lot we unwrapped here. So Eben said, even rating agencies publish credit ratings for LCUs, issues for Ghana, and they are never AAA rated. Yeah, definitely. None of these instruments are AAA rated. Of course, you can believe the AAA rating for any country at your own risk. Thank you. Good. Now, let's get into something. What if local currency bond rate is unknown? You see, here, we started the argument by saying that we know a local currency bond. We know a 10-year bond that is issued by the government recently. The government issued a 10-year bond recently. What if we don't know the yield? Even though we may be having a 10-year bond, but we don't know the yield of the 10-year bond. And that is possible because even either the bond is not trading actively on the market, so we can actually come up with a yield, with a high liquidity, like in our market here. Even before DDP program, the bond market was quite illiquid, right? And so it's difficult to actually come up with a yield. And the yield is much reliable when there's high liquidity on the market. So the bid-ask spread is quite narrow, right? Then we tend to trust the yield more. Now, in a case where there is no yield, no known yield, or we don't know the rate on a bond, either there is no bond, there's no 10-year bond to start with, or there are bonds, 10-year bonds, but we don't even know the yield. And just think about this situation where we find ourselves in this GDP that recently the government instrument or they've been issuing, Ministry of Finance have been issuing, has to do with just treasury bills. right? We're not having bonds issued. The government is yet to enter the bond market again, which is very crucial, but a lot of people are also cautioning the government to be careful. And I'll tell you why a lot of people feel the government should be careful. A lot of economists were saying the government should be careful. But suppose there is no yield, no bond at all. Like in that case, how do we come up with an estimation for a risk-free rate? We're going to look at it now. But I see people are cautioning the government because you see, when you get to the bond market, the yield that is going to be on the debt is going to give some information to investors out there about the future of the country. So if the yields are very high, it means that the country is the interest rate or inflation in the future is likely to be very high. So investors, what happens? If they realize that the estimated inflation, of course, the inflation they're even thinking about is not properly priced into the long-term bond, then if they invest in a long-term bond and realize that, of course, the expectation for inflation is going to differ from what is currently quoted in there, then they are going to lose a lot of money. Then they will move out of the country, and they may chase bonds that from countries that with low inflation and with good returns, a stable economy, and that capital flies result in a significant depreciation of the currency. That's what we call hot money crisis, right? A lot of money move out of the country to another country. That's crisis. Right. You see, there is an aspect of the story that I forgot to tell you. And the aspect is this. You see, I've been telling you about going to the US market, picking a US instrument, a 10-year US bond, and picking a yield on it. And I said that use the US market because the US government is AAA rated. But the US government is not the only country that is AAA rated. Several countries are AAA rated. Italy, Australia, right? They are AAA rated. So why not them? Germany and all that. Why not those countries as well? But you see, there are difficulties there. If we go to the Eurozone, we're going to see Italy, we're going to see France, we're going to see Germany. Now, they are all spending the same currency, the euro, I believe. Yeah. But when you get to their individual bond markets, a 10-year German bond, the yield on that, even issued around the same time with or as a 10-year French bond, the yields may differ. The yields may differ, even though they are issuing the same currency. The economic fundamentals tend to be different. So the yields may differ, even though the same currency is used by all of them. So in that case, you find it difficult determining which countries yield or bond to use as starting point for capital market expectation analysis you're doing. So the US market tends to be a favorable market to go to. So that confusion is not there. And number two, the US market is highly developed. It's the most developed financial market in the world. Right? Good. Now let's get into the argument. So what are we saying? So what if local currency bond rate is unknown? What if we don't know it? What we do? Now let's come back to our objective. So our objective is to estimate the 10-year risk-free rate for a local currency bond other than those issued by AAA rated countries. In other words, we want to estimate the yield or the risk-free rate for a government of Ghana instrument or the risk-free rate applicable to Ghana. Think about how we spend this long period just talking about risk-free rate. It's supposed to have been something very easy to estimate, but think about the time we are spending digesting this. Now, we are saying that we want to look at a situation whereby the local currency bond rate is unknown. There are two cases we need to consider. Case number one, there exists other bonds with known YTM. Here, we don't have, let's say, a 10-year bond. Either we don't have a 10-year bond or we don't have a 10-year bond with a no yield. So then the first step is that the first case we want to consider is that there exists other bonds with known YTM. Meaning we know some other bonds and we know their YTMs as well. Now, So those bonds we know are actually recently issued bonds. Okay, they are recently issued bonds. So what can we do then? We pick two bonds. Let's say we can pick, maybe we know a recently issued 5-year bond, and maybe a recently issued 20-year bond. And some of these things, as I'm saying, they are never present in the country here. But to fulfill our righteousness, we need to go through them. And there are several people who have joined us also outside the country. So we need to be fair to everyone. So if there exists other bonds in the country with different maturities that are recently issued, and we know the yield to maturity on these bonds, which is the YTM, all we need to do will be to get the yield to maturity, and then we can use a linear interpolation to determine the yield to maturity on a 10-year bond. I understand that we are using linear interpolation here. Here, we are assuming that the term structure of interest rate is having a linear slope, or so I say it's linear, right? The term structure of interest rate is linear. In our way, it has a constant slope. That's what I wanted to say, and I say a linear slope. It has a constant slope. So it's a straight line. You get a point. Now, the term structure of interest rate is not necessarily so. The term structure of interest rate tends to be curved. Okay, so you see the short end usually to be very steep, and the longer end tends to the gradient or the slope tends to be lower, right? So, but the approximation we are doing is the best we can do. So if you don't want to do the approximation, then you'll be trying to fit the curve to see how you can fit to, maybe because the various aspect of the curve, at different point of the curve, the slopes are different. So you are trying to see which area will be the 10-year bond or whatever, but it's not necessary. Just use linear interpolation. Linear interpolation, in other words, if I know a 5-year bond is this, yield is this. If I know 15-year yield is this, then what will be a 10-year yield? I can just draw a line to join, and then allocate the 10-year equivalence, and then I'm fine, right? That's one thing I can do. Now, once you do that, you get an approximation for the 10-year. And once you get approximation for the 10-year, what do? You take that 10-year bond now, and then you deduct a spread to compensate for a credit risk inherent in the government of Ghana instrument. Because I told you that because the government of Ghana instrument are not default risk-free, there's a credit spread in that yield. So that you get a yield, and then you deduct a credit spread. And we'll be looking at how to determine this credit spread soon. All right. Now, the second case here is almost like the case we have in the country here. Here, there are no bonds with known YTM. In Ghana here, especially the DDP program, we don't have any 10-year bond trading. Actively, the government didn't even issue any 10-year bond lately that we can just go for and just pick a yield and use as the risk-free rate. I determine the risk-free rate. We don't have. So that's the second case. And that is what I use almost all the time for my work. Okay, so very easy. This is how it goes. This is the case where the bond market is highly illiquid, like the situation we are facing in Ghana here. Even the DDP bonds are not really trading like that. And even if they're trading, I will still not use it. I will still not use it. Well, you can make your own decision. In this case, we start with a US bond. We start argument from a US bond with similar maturity and known YTM. So we go to the US Department of Treasury or Bloomberg, and then get a yield to maturity on the US bond, a 10-year US bond. And that is a starting point. We call that the dollar risk-free rate. The dollar risk-free rate. And that is what I denoted by RFR, dollar risk-free rate. Now, so the dollar risk-free rate here is a US bond YTM, the 10-year yield, or the yield on the 10-year US government bond. Now, my objective is to determine equivalent risk-free rate in Ghana cedi. So what am I going to do? Well, you recall this formula. In the long term, the difference in the currency values is explained by inflation. So why a currency will depreciate or not. In purchasing power parity theory, right? You recall that the long-term differentials in interest rates is between two countries is explained by the inflation expectations between the two countries, right? So, well, we can then apply that inflation to do the adjustment. Now, so using a formula, so we take the 1 plus the dollar risk-free rate and multiply by 1 plus the inflation in Ghana divided by inflation in US. Then when we do the multiplication, then we subtract 1 from the final result. There is a simpler approach. The simpler approach is this. You take the dollar risk-free rate and subtract the inflation differential between Ghana and US. Now, the idea is that the country with the higher inflation is likely to see a depreciation. If the currency of the country, and I want you to get it, if the currency of the country depreciates, if the currency, the country with the higher inflation will tend to depreciate. So that is the assumption we are factoring into this. The country whose currency it is depreciating is the one that is in the numerator here, or will have the high expectation of higher possibility of depreciating is the one at the top here. So Ghana tends to be at the top here. Of course, Ghana inflation is higher than the US inflation, right? And that is what we often see. So we're actually converting the dollar rate to a CD rate. So, well, a country whose currency depreciates will tend to see a loss in value, right? And that is the story we are trying to tell here. So that is the formula I often use for my work, and a number of practitioners also use. 1 plus dollar risk-free rate times 1 plus inflation in Ghana divided by inflation in US. Later, I'm going to tell you about the type of inflation we use. But even before we get into that, let's look at it this way. In Ghana here, in the US government tends to issue, let's say, a 10-year bond. They have the nominal bond and the Treasury inflation protected bond. The Treasury inflation protected bond protects the holder of the bond against inflation 100%. Okay, it's different from the inflation-linked bonds and all those kind of things. Some of the coupons are linked to inflation and blah, 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 and all that. Look, the Treasury inflation protected bonds, which we call the TIPS, protect the investor against inflation. If I say 100%, I don't mean that when you do your analysis, it's going to be 100%, but they give a total protection against inflation. Now, so if you take the yield on a nominal bond, that's the bond that doesn't give that protection. That's the general bond you see out there. And you take the yield on the Treasury inflation protected security in the US, a bond, a 10-year bond of the same, like they all have the same maturity, they are 10-year bond, and they all issued around the same time. The difference becomes the inflation premium built into the nominal bond. So if you want to know what inflation is the US economy pricing into the 10-year bond, is the difference between the Treasury inflation protected bond yield and the yield on a nominal bond. They are all of the same maturity and issue around the same time. That difference is the inflation expectation, and that's the inflation we are looking for. Not necessarily the inflation, the consumer price index. No, the inflation we are talking about is this one. But now let's come to reality. In the US, you can get it. So it's easier to get the inflation for US. But in Ghana, it's difficult to get. Ghana, am I even saying it's difficult? We don't have Treasury inflation protected security. So what do? We have to rely on the medium-term inflation target by Bank of Ghana, which I can confirm if they have met it before. But we tend to use the medium-term targets, right, set by the government of Ghana, the Bank of Ghana, the medium-term inflation target, and you can use that as inflation expectation for Ghana. in the numerator. So you have the dollar risk-free rate that you've got it, 1 plus that multiplied by 1 plus the inflation in Ghana divided by inflation in US. And that's what I mean. And on Monday, we're going to do the calculation, and we show that where we are calculating the total discount rate. I told you on Monday, one thing we'll do is that we will determine risk, equity premiums and all that, so we can actually calculate cost of equity, right? Today we are just setting the stage with the determination of risk-free rates, right? And the rest follow suit. Wonderful. Now we've been talking about sovereign spread, and for the case one, we talk a bit about sovereign spread, and we say if you have a bond in the country, get a bond and back out a sovereign spread. We've been making the argument. But case two, there are no bonds in the country, so we go out to the US there, and we don't have to care about sovereign spread, right? We just adjust by the differentials that reflects the currency expectation. Sometimes we call it the currency delta, right? What we use to multiply that we sometimes we call it the currency delta or the inflation delta. Sorry, the inflation delta, and we used to multiply the 1 plus the dollar risk-free rate to get a C risk-free rate. We call it inflation delta. Sometimes we do that. Now, we've been talking about sovereign default spread. Now, how do we determine the sovereign default spread? Now, so there are 3 methods, and the first one is to get a sovereign default spread. If the country or if the government has some Eurobonds, okay, have some Eurobonds, those dollar-denominated bonds have Eurobonds that are actively trading, then or recently issued, then you take the yield on the Eurobond and the yield on a US security, because the Eurobond is in dollars, the US security is also in dollars. When you take the yield on both and you subtract the yield on the US 10-year bond from the 10-year Eurobond issued in dollars, that difference is a sovereign spread. In fact, it's more of a better measure of sovereign spread than the rest of the measures. The difficulty we have in Ghana is that we are close. The external market is close on us, so the government is not able to go to float bonds on the foreign bond market, debt market. So we don't have Euro bonds actually traded. In your country, if you do, you just pick that up quickly. Now, so that difference is or gives an estimate for the default rates, because we know US government has no default rate. So the yield on the 10-year bond has no default rates. So the yield on the Euro bond of your country will be higher if your country is not triple rated, will be higher than the US bond rate. And so that differential is the compensation for sovereign credit rate. Remember, the 2 instruments are issued in the same currency. Okay, so that's how we do it. Now, that's the first method. But if the country has no Eurobond, or is not actively participating in the Eurobond market, then you can refer to the credit default swap market. Now, you see this credit default swap market, you can take it like an insurance market, right? There, you buy a bond of a government, you go and buy insurance protection, right? Go and buy protection. In case the government defaults, look, the insurance company should pay me. That's the whole story. Once the government defaults, please pay me. And so the insurance companies also have quotations for various countries, for various sovereigns. Okay, and they do for corporate as well, right? For the various sovereigns. Okay. Now, so when you go to the insurance market, depending on the credit risks associated with the sovereign, there will be a spread, right? If the credit risk is higher, meaning a poor rating, will demand for a higher spread. And so those spreads are quoted on the market for several sovereigns, and you have to check whether your country has one, or your country is traded, or maybe there's a CDS quotation for a country. If there is one, then that rate, that spread, becomes a measure of sovereign default spread. That's the second one. In case this also fails, then there is another method here. Now, the method 3 is available if you could not use the method 1 or method 2, and I tend to use method 3 a lot. In fact, almost all times I use method 3. Here, there is no dollar bond, nor CDS market for a country. In that case, what you can do is this. And I think there's a question here. Let me pick it before I get into this one. A great and insightful lesson today. With BOD medium-term inflation at 8% plus or minus 2%, where do you pick as the inflation measure expectation for Ghana? Do you choose the midpoint? It's lower band 6. Well, each time I do this, I use the upper band. So I use the upper bound of 10%. So I want to be more conservative, right? I want to be more conservative in this sense. It means that I have to use the upper bound. So I often use the upper bound there. And that's what I do. And that's what a lot of people I know also do. Right. Okay. So now if we don't have the CDS market and also there is no dollar denominated bond, then how do you do this? Now, this case, Damodaran did a very interesting work, and he's a professor of finance, and he's regarded as an authority in corporate finance, right? He did a very interesting work where he gathered the sovereign ratings of almost every country, in fact, most countries that are rated by Moody's, Fitch, or S&P. And then, with those sovereign ratings, he's able to come out with a spread, a sovereign spread for each of them, and has done the calculation nicely. And you can visit his site to learn more about how he approached the calculation. And so that is something you can use, and that is what I use a lot of the time. And on the next slide, you tend to see a table I produce. So these days, let me just connect my power, please. A moment as we wrap up, please. Okay. I'm back. I hope I'm audible, right? I'm audible, please. Maybe something in the chat just to revive it. If you can hear me. Good. Good. Great. All right, thank you. All right, so something has been done here. He has done this on his site, and of course you can have a look at it. So these are Moody's ratings. So I just produced this out, a sample. So you look at how you see how it looks like. And so you have Benin Republic is rated by Moody's B1, and then the associated default spread is 4.46. It's an authority, so you can actually use these figures here. All right. Burkina Faso is rated CA1, and 7.43 is the default spread, the sovereign default spread, I mean. And so you see China here. There's something I want to show you. So see China. China is A1, 0.7. But US, look at US. US is AAA rated. Look at it, 0.00. No default risk. Okay, no default risk. So 0.00. And then Nigeria is CA1 at 7.43, a little below that of Ghana. So Ghana, at a point, Ghana was in special default, right? But then we experiencing some economic recovery. So we now 8.92. So in this case, if you have government of Ghana bond, and then you recently you want to determine risk-free rate, you take the yield on the bond and you subtract 8.92%, and that gives you the risk-free rate in Ghana. Well, this concept of default spread, the sovereign default spread. We're going to explore it further on Monday because when we want to determine the equity risk premium for an investment in an emerging market like Ghana, we need to use the sovereign default spread to measure to account for something called a country risk premium. We will use the sovereign default spread to calculate the country risk premium. And so Monday class is going to be a bit difficult. Not difficult in that sense, but I'll show you the things that you've been seeing in textbooks, which you may not really understand. I'll show you how the transition happened from standard deviation to beta, how a simple linear regression model transition from the linear regression model to the capital asset pricing model, where we now have risk-free rates. I'm going to show you all that, right? I'll tell you the whole story on Monday and how we can estimate cost of equity, how we can estimate expected equity risk premium, and the models that we can use. I'll use a few models. The CAPM is there, but I'll use another one. I think I will make use of the Greenwald-Kroner model as well, which sometimes I use. So I'm going to talk about a number of stuff on Monday, and I hope you really enjoyed it. So let me see if there's any question I take before we go. Before I end my lecture for today. Very insightful presentation. Can't wait for Monday. Yeah, Monday is going to be very interesting. I'll do some Excel work on Monday, and then Monday too we'll solve some questions on how to determine the cost of equity. We are going to do things. In fact, this lecture is going to be extremely practical, so you don't have anything to worry about. Right? Let's see how things go. Any question? Any further question, guys? Is there any further question for me to respond to? As I always do, take a few minutes to write something in the chat. We've ended today's lecture. We talk about how to determine risk-free rate. I said that, well, the government of Ghana instrument is not risk-free because the issuer is not AAA rated and the issuer has a reinvestment risks associated with the instrument. But the key thing is that default risk-free. It's not default risk-free. And we stated that even though the 10-year bond has the reinvestment rates, we tend to use it, we tend to prioritize it for valuation purposes. And we went ahead to say that, well, we'll start the argument from a developed market, a market that has, like the United States market, that has a AAA rating. And then we pick an instrument there that is risk-free, 10-year US bond, and then we need to make adjustment, and we can make adjustment by multiplying 1 plus that US rate by the inflation delta, and that gives us the yield in Ghana. We subtract 1 from it, and it gives us the approximated risk-free rate in Ghana City. And we also talk about the fact that if you have some instrument here in Ghana already trading, you pick that the yield on the instrument recently issued by the government of Ghana, a 10-year bond, and you back our sovereign default spread. And we say sovereign default spread, there's 3 ways to calculate it. You can get it from the Eurobond market, take the Eurobond minus the US sovereign, and that gives you that. Or you go to the CDS market, see the spread quotations, and you can use something there. Or you can use the Damodaran's sovereign rating spread table, and where you know the rating for your country, and you see the corresponding sovereign rating. And that's been the argument we've made for today. And we're going to see all these things in actions on Monday. Please take a few minutes to write something in the chat. Let me know how you felt in the class today, how insightful the class has been to you, and the new things you've learned, and what your expectations are in the upcoming class. Because I'll be completing this module on Monday. From Tuesday, we'll get into something else, and I'm not rushing this work, this lecture, because I want you to get a maximum best out of it. I'm here because of you, right? So there's no need to rush it. Very insightful. I learned that the criteria for risk-free rate is no default risk and no reinvestment rate. And also how adjusting by the sovereign spread gives you the true risk-free. Wow, that's wonderful, Mamle. That's true. Who else has something to type? Just type something to know that you actively, or you are here with me. I want to see something type. Mamifa said, always a delight. Looking forward to the upcoming sections. Great. I'll be happy to have you here. Today's lessons mean we have been deceived by our lecturers. Well, I don't know about that. eager for Monday's lesson. Thanks for today. Thank you too. What else? What else? What else do you have to say? Zal, to a lot, not maybe, did I confuse you today? Was the class difficult? I want to know. So that will guide me in Monday's class. I want to know if you found today's class too technical. And thank you so much, Julius. You have forever changed the concept of risk-free rate for me. Can't wait for Monday. Yeah, you see a lot of things on Monday. A lot more things on Monday. Anything else from anyone? Okay, so well done. It was insightful. Thank you very much. Okay, great. It is exactly 7:20 by my watch, and Ifri, over to you as we wait for others to write. The pace of the class was good, easy to follow. So I found the criteria for qualifying risk-free rate very insightful. Risk-free rate will never be defined the same way again. Today was a lot to unpack, especially considering the determination of the risk-free rate. Oh, thank you thank you for the questions you've been asking, Mamle. Thank you all for the questions that you've been asking. I found them very useful. I want more questions to so that we can make the discussion more interactive. And also, even if I forget things, I'll be able to recall them. Hi, Ifri.
Hi, Julius.
Yeah, over to you.
Thank you for today's session again. And as always, nothing much from me. We would share the first set of slides hopefully by Monday. So please keep an eye on that, your email boxes. So please, if you join us with any link without going through the registration process, kindly do so that you have access to the shared materials. So without much to say, good evening and enjoy your weekend. It's not long this time.
All right, same to you. Thank you for having me here. Thank you.